In the year gold disappeared from the market, nothing dramatic happened on the surface. There were no headlines about empty mines, no viral photos of vaults running dry, no sudden price explosion that would normally signal a supply shock. Gold prices moved, but not in a way that screamed crisis. And that was precisely the problem. What was happening did not look like a shortage. It looked like business, as usual, until you tried to buy real gold. At first, the signals were small and easy to dismiss. Dealers began quoting higher premiums over spot price, not because demand was exploding, but because delivery was taking longer. A 1-week wait quietly became 3 weeks. 3 weeks became subject to availability. Large bars that had always been easy to source suddenly required advance notice. Smaller coins were still available, but in shrinking quantities. Nothing officially broke. Nothing officially failed. Yet friction was creeping into a market that was supposed to be among the most liquid in the world. Gold is not supposed to behave like this. Unlike rare earths or niche commodities, gold has an enormous above-ground supply. According to estimates from the World Gold Council, more than 200,000 tons of gold have been mined throughout history, most of it still existing in some form. This is why gold shortages are usually considered impossible. Gold does not get consumed. It gets stored, traded, melted, reshaped, and moved. When demand rises, supply is supposed to appear from vaults, from ETFs, from central bank leasing, from recycled jewelry. And yet, in this year, supply did not respond the way textbooks said it should. On paper, everything looked fine. Gold-backed ETFs continued to report substantial holdings. Futures market showed ample open interest. The London Bullion Market Association still cleared billions of dollars worth of gold trades daily. Central banks published reserve figures with little fanfare. If you stayed inside the financial abstraction layer charts, reports, balance sheets, gold was everywhere. But if you stepped outside that layer and tried to touch it, the market felt strangely hollow. The disconnect became clearer when delivery timelines started to matter more than price. Buyers willing to pay above spot still could not get immediate settlement in metal. Some refineries prioritized long-term contracts over spot orders. Others quietly reduced retail allocations. Even sovereign mints, traditionally reliable sources of bullion coins, began rationing production or temporarily suspending sales, citing logistical constraints or unprecedented demand. These explanations sounded benign, but together they formed a pattern that was hard to ignore. This was not a panic. It was something colder. There were no queues outside bullion shops, no rush driven by fear headlines. Instead, gold was being absorbed steadily, persistently, and without noise. That absence of noise was the key clue. Markets panicked loudly. Structural shifts happened quietly. One of the strangest aspects was how little the price reflected the tension. In previous periods of gold stress, the 1970s inflation shock, the 2008 financial crisis, the pandemic liquidity freeze, price moved violently. This time, price action lagged behind physical reality. Futures prices suggested adequate supply. Spot prices adjusted gradually. Yet premiums told a different story, especially outside major financial hubs. In part of Asia and the Middle East, physical gold traded at consistent markups, signaling localized scarcity that never fully fed back into global benchmarks. This raised an uncomfortable question, whether the gold market was no longer a single market, whether it had split into two layers, one liquid, fast and paper-based, and another slow, physical, and increasingly inaccessible. The idea was not new. Analysts had long discussed the difference between gold on paper and gold in hand, but it had always been theoretical, a risk to consider rather than a lived reality. Now, that theory was becoming tangible. When delivery matters, paper gold and physical gold stop being interchangeable. And when they stop being interchangeable, price stops being the full story. To understand why this mattered, consider how most gold trading actually works. The vast majority of transactions never involve metal moving at all. They are settled in cash, rolled over, netted out, or closed before delivery. This system functions smoothly as long as confidence remains intact, confidence that metal exists somewhere, that it can be accessed if needed, and that not everyone will ask for it at the same time. The year gold disappeared was a year that confidence quietly began to thin. Importantly, this was not driven by retail investors. Data from major markets showed that household gold demand was elevated but not extreme. Jewelry demand fluctuated but followed familiar economic cycles. This was not a story of people emptying shops in fear. Something else was removing metal from circulation, something large enough to affect availability but subtle enough to avoid headlines. Another clue lay in what was not happening. Normally, when physical gold tightens, leasing rates spike. Banks borrow gold from central banks or large holders, sell into the market, and later repay it. This process increases supply during periods of stress. But leasing activity remained muted. Gold was not being lent out the way it had been in previous cycles. That suggested that major holders were choosing to keep their gold where it was not mobilizing it, not monetizing it, not recycling it back into the system. Why would anyone do that? Gold earns no yield. In a world of rising interest rates and high inflation, holding gold instead of interest-bearing assets carries an opportunity cost. For decades, this logic had encouraged central banks and institutions to treat gold as a secondary asset, useful but inefficient. Yet now, that logic seemed to be reversing, and without announcement. The disappearance of gold was not about scarcity in the geological sense. Mines continued to operate. Production numbers did not collapse. Recycling flows existed. The metal itself had not vanished. What had vanished was willingness. Willingness to sell. Willingness to lease. Willingness to let gold circulate freely through the global financial bloodstream. This distinction matters because markets are not just about supply. They are about access. Oil can exist underground, but if it cannot be shipped, it does not function as supply. Capital can exist on balance sheets, but if it cannot move, it does not function as liquidity. Gold can exist in vaults, but if it does not come back to market, it effectively disappears. By the end of the year, observers began to realize that something fundamental had shifted. Gold had not been bought aggressively in one dramatic sweep. It had been withdrawn patiently, transaction by transaction, shipment by shipment, contract by contract. No single purchase made headlines. No single buyer dominated the tape. Yet the cumulative effect was unmistakable. Less gold available where it used to be easily accessible. The most unsettling question was also the simplest one. If gold was leaving the open market and ordinary buyers were not the ones taking it, then who was? And more importantly, why would they want it back now, after decades of treating gold as a relic? The answer to that question did not lie in price charts or mining reports. It lay in the identity of the buyers. No one was watching buyers who do not chase returns, do not explain themselves to markets, and do not care about short-term price signals. Buyers for whom gold is not a trade, but a strategic asset. That is where the story truly begins. The buyers were not hedge funds, and they were not retail investors stacking coins in response to fear. They did not move quickly, and they did not announce themselves. In fact, the defining feature of the buyers behind gold's disappearance was how deliberately invisible they were. They did not compete on price in the open market. They did not chase rallies. They bought in ways designed to avoid being seen at all. These buyers were central banks and National Reserve authorities, and their behavior marked a quiet but profound shift in how gold was being treated inside the global financial system. For years, central banks had publicly downplayed gold's importance. It was described as a legacy asset, a historical artifact from the Bretton Woods era, something held for diversification but no longer central to monetary power. Official speeches emphasized modern tools, interest rates, forward guidance, quantitative easing, swap lines. Gold was mentioned rarely, and when it was framed as passive. Yet the data told a different story. According to figures compiled by the World Gold Council, central banks collectively became net buyers of gold at levels not seen since the collapse of the gold standard. Year after year, purchases exceeded hundreds of tons, even as gold paid no yield and storage costs remained. What made this buy unusual was not just the volume, but the method. Central banks were not sourcing gold the way private investors did. They avoided spot markets where trades are visible and prices react immediately. Instead, they relied on bilateral agreements, long-term supply contracts, off-market transactions with domestic producers, and transfers that never touched public exchanges. In some cases, gold was bought directly from local mines and routed straight into national vaults, bypassing global trading hubs entirely. This meant that large amount of metal could be removed from circulation without ever appearing as demand pressure in the price. China offered one of the clearest examples. Officially reported gold reserve increases appeared sporadic, sometimes announced months after the metal had already been acquired. Analysts widely accepted that actual accumulation likely occurred continuously, with disclosure delayed or selectively timed. The People's Bank of China had strong incentives to behave this way. Buying aggressively on the open market would have driven prices higher and signaled strategic intent. Buying quietly allowed accumulation at lower average costs while maintaining ambiguity. Russia followed a similar pattern for years, steadily converting foreign exchange inflows into gold, often through domestic production channels that never intersected with London or New York markets. Turkey, Kazakhstan, Uzbekistan, India, and several Middle Eastern central banks also increased their gold reserves, often during periods when the metal was falling out of favor with Western investors. This was not coincidence. These institutions were not trading gold as a momentum asset. They were treating it as insurance, accumulated when sentiment was weak and prices were politically quiet. Unlike private investors, central banks do not need to justify timing to shareholders. Their mandate is stability, not performance. Another important detail was what these buyers did not do after acquiring gold. They did not lease it back into the market. In previous decades, central banks often lent gold to bullion banks, which sold it into the market to earn yield and increase liquidity. This practice helped suppress volatility and ensured that gold flowed freely through the financial system. But in the year gold disappeared, this behavior changed. Leasing volumes declined, and existing leases were allowed to mature without renewal. Gold that entered national vaults tended to stay there. This decision had consequences. When gold is leased, it remains functionally liquid even if ownership is concentrated. When it is hoarded, it is removed from the pool that supports futures delivery, ETF redemption, and spot settlement. The market can tolerate paper leverage as long as enough physical metal is willing to move when needed. Once that willingness declines, the system becomes fragile even if headline inventories appear large. What drove this shift was not a single event, but a growing awareness of financial vulnerability. Central banks had watched reserves frozen, payment systems weaponized, and access to dollar liquidity turned into a geopolitical tool. Assets once assumed to be neutral were revealed to be conditional. Foreign exchange reserves held in another country's banking system could be rendered unusable overnight. Government bonds could be sanctioned. Payment rails could be shut down. Gold, when physically held within national borders, was immune to all of this. This distinction explains why central banks cared not just about owning gold, but about where it was stored. Several countries undertook highly publicized efforts to repatriate gold from foreign vaults, citing transparency or domestic accountability. But the strategic logic was clear. Gold stored abroad is still subject to foreign legal frameworks. Gold stored at home is not. In an environment where trust between states was eroding, physical control mattered more than financial convenience. Crucially, these buyers were insensitive to short-term price movements. A private investor might delay a purchase after a rally or sell into strength. A central bank thinking in decades does neither. It accumulates steadily, often counter-cyclically, and measures success not in returns but in resilience. This meant that once gold flowed into official reserves, it effectively left the market for good. There was no expectation that it would be resold to meet demand or smooth volatility. The scale of this behavior was easy to underestimate because it lacked drama. A few tons here, a few tons there, spread across months and countries, does not look threatening. But gold markets are finely balanced. Annual mine supply is limited. Recycling responds slowly, and much of the existing stock is held tightly by long-term owners. When even a small percentage of that flow is diverted into vaults that never sell, the effect compounds. This helps explain why shortages appeared unevenly. Global benchmarks did not scream crisis because futures and ETs continue to trade normally. But at the margin, physical availability tightened. Premiums rose. Delivery times stretched. The system still functioned, but with less slack. And unlike a panic-driven run, this tightening did not reverse when prices stabilized. The buyers were not price-sensitive, and they were not done. Perhaps the most important insight is that central banks were not reacting to gold's performance. They were reacting to the world around it. Gold's disappearance was not a bet on inflation alone, or on currency debasement in isolation. It was a response to a deeper realization that in a fragmented global order, assets that depend on trust, cooperation, and legal reciprocity carry hidden risks. By the time analysts began openly discussing the scale of official gold buying, much of the metal was already gone from the channels that once made it accessible. The market was left trying to price a reality that had been forming quietly for years. And while investors debated whether gold was cheap or expensive, the most powerful buyers in the system were answering a different question entirely. What assets still work when the rules change? That question would lead directly to why gold was being pulled back home and why this process was accelerating rather than slowing. Gold was not being pulled back into national vaults because central banks suddenly became nostalgic. It was being pulled back because the assumptions that had governed reserve management for decades were breaking down. For most of the post-Cold War era, the global financial system operated on a shared belief that economic interdependence reduced the likelihood of financial rupture. Reserves could be held abroad. Currencies could be freely exchanged, and government bonds issued by major powers were considered risk-free not just in credit terms, but in political ones. The year gold disappeared was a year that belief finally lost its authority. The turning point did not come from inflation alone. Inflation changes relative prices. It does not change trust. What changed trust was a realization that financial infrastructure itself had become a weapon. When reserves could be frozen, transactions blocked, and access to settlement systems revoked based on political alignment, central banks had to reassess what safety actually meant. An asset that performs well in normal times but fails under stress is not a reserve. It is a contingent claim. Gold, by contrast, had one defining feature that no modern financial asset could replicate. It did not require permission to function. This distinction explains why gold regained relevance even as it remained inefficient by traditional metrics. Gold yields nothing. It incurs storage costs. It does not scale digitally. And yet, none of these disadvantages mattered once the primary risk was no longer volatility, but access. A government bond held in a foreign custodian might pay interest, but it could also become unusable overnight. A foreign currency reserve might be liquid, but only as long as corresponding banking relationships remained intact. Gold, once inside a country's own vault, was final. There was no counterparty to default, no switch to turn off. The logic was brutally simple. In a world where rules could change faster than contracts, physical control outweighed financial optimization. Central banks were not seeking returns. They were seeking autonomy. Gold was not being accumulated as a hedge against inflation in consumer prices, but as a hedge against systemic exclusion. It was insurance against a future where the global financial system fractured into blocks with limited interoperability. This also explains why repatriation became as important as accumulation. Owning gold on paper or even in allocated accounts abroad was no longer sufficient. Several countries that had long stored gold in London or New York began to bring it home, often citing public accountability or symbolic sovereignty. But the underlying driver was strategic. Gold held under another jurisdiction's legal system is subject to that system's discretion. Gold held domestically is not. In an environment where legal risk had become geopolitical risk, jurisdiction mattered more than yield. Another factor accelerating this shift was the changing nature of reserve assets themselves. For decades, U.S. Treasury bonds had served as a cornerstone of global reserves. They were deep, liquid, and backed by the world's largest economy. But as debt levels rose and monetary policy became increasingly unconventional, treasuries began to acquire a different risk profile. Not a risk of default in the traditional sense, but a risk of dilution and politicization. Quantitative easing blurred the line between monetary stability and fiscal financing. Sanctions blurred the line between financial prudence and political alignment. For reserve managers, this created a dilemma. Reducing exposure to treasuries meant accepting lower liquidity or higher volatility elsewhere. Holding more cash meant exposure to inflation and devaluation. Diversifying into other currencies meant inheriting similar political risks, just from different centers of power. Gold, despite its flaws, stood outside this matrix. It was no one else's liability. It could not be printed. It could not be sanctioned in the same way as a bank account or bond holding. Importantly, gold's appeal was not that it would replace existing systems, but that it would remain functional if those systems failed. Central banks were not preparing for a smooth transition. They were preparing for disorder. History offered enough precedent to make this rational. Monetary regimes do not collapse politely. They fracture, they overlap, and they leave gaps where settlement breaks down. In those gaps, only assets that are universally recognized and physically controllable retain value. This perspective also sheds light on why digital alternatives failed to displace gold in reserve strategy. Cryptocurrencies promise censorship resistance and portability, but they introduce new dependencies: electricity, networks, software integrity, and regulatory tolerance. For individuals, these trade-offs might be acceptable. For states, they were not. A reserve asset that can be restricted through infrastructure, regulation, or coordinated policy is still vulnerable. Gold's technological simplicity became an advantage, not a weakness. The same logic applied to synthetic and paper representations of gold. Futures contracts, unallocated accounts, and ETFs offer exposure, but not sovereignty. They depended on clearinghouses, custodians, and legal frameworks that could be disrupted. In a systemic crisis, these layers add friction precisely when friction is most dangerous. Central banks understood this. That is why they demanded physical delivery, direct custody, and clear title. The objective was not exposure to gold's price, but possession of gold itself. As gold was pulled out of circulation and locked away, the open market was left with a shrinking pool of truly available metal. This did not trigger immediate failure because the system is designed to function with leverage. Paper claims can multiply around a static physical base as long as redemption remains rare. But leverage increases fragility. Each ounce removed from the deliverable pool reduces the margin for error. Each repatriation narrows the window in which trust can absorb stress. By the time this dynamic became visible, it was already self-reinforcing. The more gold was withdrawn, the more valuable physical control became. The more valuable physical control became, the less willing holders were to part with it. This feedback loop did not require panic to operate. It only required patience and conviction, qualities central banks possess in abundance. The deeper implication was unsettling. Gold was not being hoarded because collapse was imminent, but because collapse was conceivable. The mere possibility that financial access could be revoked was enough to change behavior. Once that mental shift occurred, there was no reason to stop. Gold did not need to outperform other assets. It only needed to remain what it had always been, the one asset that survives when trust does not. By withdrawing gold from the open market, central banks were not sending a message to investors. They were sending a message to each other. A signal that reliance on shared systems had limits. A signal that monetary power was returning quietly to what could be held, not what could be promised. The consequences of that signal would not remain confined to vaults. They would surface in the market, left behind a market that still looked liquid, still quoted prices, and still functioned day to day, but it was increasingly disconnected from the metal it claimed to represent. That disconnect would define the final act of gold's disappearance. By the time the consequences reached the open market, the damage had already been done. Nothing snapped. Nothing collapsed. The gold market did not fail in a way that demanded emergency meetings or rescue packages. It simply became thinner, more fragile, and more unequal. The metal was still quoted, still traded, still referenced in headlines, but was no longer circulating the way it once had. What remained was a market that looked liquid, but behaved as if it were running on reserve. For ordinary participants, this was difficult to detect. Screens still showed prices updating every second. Futures contracts rolled over smoothly. ETFs continued to publish daily holdings. From a distance, gold appeared more financialized than ever. But beneath that surface, the character of the market had changed. Liquidity had become conditional. Availability had become selective. The question was no longer what is the price of gold, but what kind of gold, where, and under what terms. The divergence between paper gold and physical gold, long discussed in theory, became practical reality. Paper gold remained abundant. Exposure could be bought instantly, in size, with minimal friction. Physical gold, by contrast, increasingly required patience, connections, and compromises. Buyers were asked to accept delayed delivery, substitute products, or higher premiums. In some jurisdictions, they were simply told no, not because gold did not exist, but because it was no longer offered. This created a two-tier market that pricing mechanisms struggled to reconcile. Futures prices reflected expectations and financial flows. Physical premiums reflected scarcity and logistics. When these two signals diverged, arbitrage should have closed the gap. But arbitrage requires metal to move, and metal was precisely what was no longer moving freely. Gold sitting in national vaults could not respond to price signals. Gold held by long-term strategic owners had no incentive to rotate back into circulation. The invisible hand was reaching for gold and finding nothing to grasp. For investors who believed they owned gold through financial instruments, this raised uncomfortable questions. Ownership on paper is only meaningful if it can be converted into ownership in fact. In normal conditions, that assumption holds. In stress conditions, it is tested. The year gold disappeared did not bring the test to its conclusion, but it brought it close enough to matter. Redemption clauses, settlement terms, and custodial structures details, once ignored, began to carry weight. The irony was that the system still depended on trust, even as trust was eroding. Most holders of paper gold never intended to take delivery. That remained true. But the system's stability did not require everyone to demand metal, only enough people to do so at the wrong time. As physical buffers shrank, the margin for error narrowed. A market can survive high leverage. It cannot survive uncertainty about whether leverage can be unwound. Meanwhile, the countries that had withdrawn gold were largely indifferent to these tensions. Their objectives had been met. They had secured assets that could not be frozen, diluted, or blocked. They had reduced reliance on systems they did not control. They had accepted lower financial efficiency in exchange for higher strategic resilience. Whether the open market functioned smoothly was not their concern. Their gold was not for sale. This asymmetry mattered. The most powerful actors had exited the market as sellers and lenders, leaving behind participants who depended on liquidity but could not create it. The result was a market that still cleared trades, but increasingly on terms dictated by those who did not need it. Power had shifted away from price discovery and toward possession. Over time, this reshaped behavior. Long-term holders became more reluctant to part with physical gold, even at attractive prices. Dealers managed inventory more conservatively. Refineries prioritized sovereign and institutional contracts over discretionary supply. Each rational decision, taken in isolation, reinforced a collective outcome. Gold flowed upward into vaults designed not for turnover, but for permanence. The most striking aspect was how little public attention this received. There was no single moment to point to, no dramatic inflection on a chart. The disappearance of gold did not announce itself because it did not need to. It unfolded in a world saturated with information, where only loud events are noticed. Quiet accumulation, by design, leaves no spectacle. And yet, the implications were profound. Gold has always functioned as a confidence barometer, not because of what it does, but because of what it does not depend on. When gold moves from circulation into custody, it signals a preference for certainty over convenience. When that movement is led by states rather than individuals, it signals a deeper recalibration of risk. For those left in the market, the lesson was subtle but clear. Liquidity is not a permanent feature. It is a condition sustained by incentives and trust. When incentives change, liquidity evaporates long before prices adjust. By the time price reflects reality, access is already gone. This is why the year gold disappeared was not defined by a price spike. It was defined by absence, by delays where immediacy once existed, by explanations where availability once sufficed, by the growing realization that the market people thought they were participating in was no longer the same market operating behind the scenes. Gold did not vanish because the world ran out of it. It vanished because those who mattered most decided they did not want it to circulate anymore. They did not ring bells or issue warnings. They simply took possession and closed the door behind them. In the end, the story is not about gold alone. It is about how systems change without asking for permission, about how power moves quietly, leaving familiar structures intact but hollowed out, about how markets can continue to function even as their foundations are being rearranged. When the next crisis arrives, whether financial, political, or monetary, the question will not be how high gold goes. It will be who already has it, where it is held, and whether anyone else can still get it. That is what the disappearance of gold was really about.